Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday?
What if by changing just one thing, everything would be better financially for your family? How many of you would make that one change? And how many of you want more money? And if you didn't say aye to that, then you got something to explore, because that one paradigm shift and new skill set is the gap between you and the wealthiest families. It's a difference between being a borrower and at their mercy, or being a builder and in control. So welcome. Congratulations for being here today. High five your neighbor. High five to you. How many people could have been here today and they chose not to be? But you showed up for yourself and those that you love and for your community. And that is just awesome. So in the next 6 hours, I'm going to let you in on a little known secret, a little known fact that the wealthiest families and visionaries like the Rockefellers and Walt Disney have been using the strategy called the infinite banking concept for ages to build and preserve their empires. And the strategy is simple, it's legal, and it's something that each and every one of you have access to. And it all starts with changing that one thing. And strangely, it's loving yourself more. Start paying yourself first. Stop being last in line for your money. Because shockingly, we're giving away a big chunk of all of our money every time we get paid to the bank, to the government, and to Wall Street, to them. And I'm going to show you how you can take back control from them. Would it be okay if I shared a little bit about myself and why I am so passionate about this subject? Imagine this. They're going to give you a job where you get to work an extra 30 hours a week, and you're going to take on a ton of additional roles to the point where you have a different role for every day of the week. Stress and responsibilities. You're showing up first, you're leaving last. And bonus, here it is. You make zero extra money and have no equity in the company. How many of you would want to do that? Nobody. You'd have to be an idiot to do that. But then it gets worse. I leave that role, start my own company, and within a year, I find myself in another role in leadership, helping a coach build his coaching platform in the first year of the pandemic from $0 to $4 million. But now I'm working 15 to 18 hours, 7 days a week, and I'm making a third of what I was making in corporate America. Who in their right mind would do that? Again, nobody. You'd have to be crazy. But guess who did that twice? This guy. Then I hit rock bottom. I was at a mastermind in the back of the room, helping lead and going through an exercise, and the coach up front was asking everybody, how much money will you have 5 years from now? What are your dreams? Who will you be with? Where will you be? Where are you going to live? What are you going to be doing? How much impact in the world? Who are you saving? What are you doing for your friends, for your family, for those around you? And as everyone else was getting amped up and excited about what was possible, in that moment, I broke down and I started crying. And I felt like I was failing my sons, my wife, everyone I care about. And then I got real with myself. I realized I had some rules I realized I was at the end of the line with that journey. And as I looked down from the bottom, I thought, it can't get any worse than this. I've completely failed. I'm away from home. I'm not making hardly any money. Yes, I'm helping people, but there's nothing that's helping my family. And I knew I needed help. And I got humble. And I asked a brother of mine, a good friend of mine, I said, hey, Rep, I need help, man. I need a financial philosophy. I have one for being a father, for being an athlete, for being just a man in general, but I don't have a philosophy for my spirituality, but I don't have one for money. And he handed me a book. And this small, powerful book, I went home that day. It was about 30 minutes from me. I drove home. I was excited that night. I was like, if this is the key, I'm going to read it. And I read it that night. And don't be too impressed. It's only 91 pages. And guess what happened? I got angry. I got viscerally mad, cussing, mad. And I read it again the next day because I thought if this was true, every single American would do this. And that became my mission. That is why I am here today with you. Because by the time our time together is over, you're going to know the secret that the wealthy know. And you're going to know what to do. You're going to know how the banks take your money and they make tons of money, shocking amounts of money from the money that you've worked so hard to earn and store in their system. You're going to know how you can give yourself a raise and recapture all of the interest, which turns your debts into assets, along with creating a generational guaranteed legacy and the resourcefulness, the thinking to pass it on. And a few years ago, I thought this wasn't available. I was scared. I was lost. I was worried about money. But my family, we've applied this. We've succeeded with this more than I could even imagine. And today I'm going to show you how you can do the same. How many of you would think if you knew any of these things, one of these things, that would be valuable? And if you think that this is unattainable right now, if you're listening and you're new here, again, if you're new here, because I promise you it's within your grasp. My only request is that you hold the space, that whatever you don't know, add a 3-letter word at the end. I don't know this ... yet, because everything begins with the way we think. The real estate right here. And by changing that one thing, adding one thing to your existing system will change everything. So let's hop in. Nelson Nash once said that the infinite banking concept, and we're going to do a lot of this today, the infinite banking concept, it was nothing more than a exercise of imagination, reason, logic, and prophecy. I like to add faith, but I think that's implied in Nelson's vision. And so now I want all of you, as long as you're not driving, right? No crashing. I want all of you to join me in an exercise of imagination. We're going to do this a couple times. So for this one, we're all going to close our eyes and we're going to go back. We're going to go in the way back machine for some of us and the not so far back machine for others and the way back machine for some of you. But we're going to imagine we're back to being high school seniors and we're graduating high school. And now I am on stage and I'm asking you simply, how many of you are going to be rich or wealthy by the time you reach retirement? You're all going to be jumping up, screaming out and go, ooh, me, Jason, call on me. I'm going to be the next Bill Gates, the next Warren Buffett, the next Elon, the next maybe Donald Trump, the next Zuckerberg. I am going to be the next Bezos, the next big thing. You are excited. Everything is still possible because life hasn't taught you otherwise yet. And you're so excited about your future. But then over the decades, since we graduated high school, you know, for me, a long time ago at this point, and since I've graduated, things have slowly shifted. And it's been slow. It's almost imperceivable. And it's insidious. And what I'm talking about is this shocking statistic. According to the Social Security Administration, only 5 out of 100 Americans will be financially secure, not free, financially secure at retirement age, which is defined at age 67. I think that's a made-up age and a made-up thing, but how is this possible? Now, I know it's not you. all of you here, because you're already in the 5%. You're already in the ones that are applying the new thinking and being willing to make that shift for yourself and for your family. So it's not you. So I congratulate you, each of you, for being here, because you're in the minority. But only 5 out of 100 Americans financially secure, that's a travesty. That has to change. We have to change that together. We can do better. We can do better for our peers, for our friends, for our family, and for the Americans that we don't know. We are the greatest country in the world at the greatest time in history, earning the most money that's ever been earned. There is a way that we can keep more of that money. So this statistic will change. We will make this change together. And it's very much like Will Rogers said, the problem in America isn't what people don't know. It's not the little slice of pie we don't know. It's what we think we know that just ain't so. So let's, I kind of alluded to the book that changed my life. Let's talk about some of the people that you all know, because even though this is a little known concept used by the wealthiest families, there's a lot of names that you and I are familiar with that have written, used, and talked about this. The first guy, and this confused my son the other day, he's like, how did he have a rich dad and a poor dad, Dad? And I had to explain to him. But Robert Kiyosaki talked about this very concept. And actually, I've seen letters from Robert to some of my peers about his specially engineered whole life, but he talks about it in Second Chance. And then there's a man who changed my thinking, rewired my nervous system, and it sent me on this journey to find what a better route looked like. And that's the big man himself, Tony Robbins. And Money Master the Game, section 5.2, Tony talks about this. A lot of you entrepreneurs out there love Tony. But the one that changed my life, the book that my mentor handed me, was this book, Becoming Your Own Banker by R. Nelson Nash. And if you ever work with me, talk to me, or mentored by me, I will tell you and teach you how to read this book. I will tell you what to read first, how to go through it. So just keep that in mind as you're thinking about, should you start this journey or not? And then my peers, my partners, you got mapping out the millionaire mystery. And that's what we're going to do here together. I'm going to show you how one of our clients used this concept by the end to map out and recapture and have over $1 million back in his family that would have left forever. So we're going to map that out together. And then once you understand banking, you want to start understanding how you can work with other people that you know, like, and understand with the Private Money Guide. So let's talk about this interesting concept. Let's talk about this intriguing concept. Look at that thing. What is that, Jason? Oh, it's the backwards bicycle. Now, it started out as a welder playing a joke on some of the engineers. And now when you all learned how to ride a bike, and hopefully you all know how to ride a bike, but remember back when you were riding your bike for the first time, right? All of a sudden you press down on the pedal and what happens? The bike lurches forward, and the harder you pedal, the faster you go. Your hair starts flying back. You're going so fast, especially in the 80s, your mullet's flying out the back. So you're flying down the street and you turn the handlebars to the right and the bike goes to the right. You turn the handlebars to the left and the bike goes to the left. And then boom, crash, you get up, you're crying. You're like, my hands, that hurt so bad. What the heck? You got rocks in you. If you grew up where I did on chip paved roads, you got rocks in your hands. And you look back and mom and dad are no longer running behind you. They let you go. Did you quit? Did you stop? Did you never want to ride your bike again? No. You got back on that bike and you kept at it, and it became that first, for me, it was my first freedom as a kid. What if your bike didn't work that way? What if you turned the handlebars to the left, the bike went right? And now you're flying down the street and you want to go right, and so you got to turn the handlebars to the left. How many of you think you could ride that bike? Anybody? I always say I can, but I know from seeing this that I wouldn't be able to for a while. I would have to retrain my brain. And that's what happens. What if our money works exactly like this backwards bicycle? You've been trained and taught and you've used your money a certain way all of your life. But what if those neural pathways that you believe are true, but are the reason you're here today is because you want more money, more time, more magic weren't actually the truth, and you would have to relearn anything or everything. It might take a little bit of time, but just like I said in the beginning, you just don't know it yet. So give yourself space, time, and patience to ride this backwards bicycle. So let's talk about some of the reasons why more of us, because again, we're the greatest earning country in the world, why aren't more people successful? Have you guys sat down and thought about this? You know, I always said there's two parts to this. There is the math and the mindset. So let's look at some of the wealth killers. Taxes. Does anyone here not pay enough in taxes? Next, inflation. Think about feeding your family. I bet if you thought back 5 years ago, it cost a lot more, especially if you have boys, to feed them today. Market volatility. The market goes up, it goes down, it goes up. We were in the longest bull run ever, right, in the last century. And now we're getting that fluctuation. We're still up, but for how long? Interest. And this is the part where you're going to give yourself a huge raise later by just changing how you approach the interest in your life and the interest you're paying to other families. And then on the mindset side, we have following the status quo. I joke around and say, this is the sheeple in the world, the people just following. Like, remember when you were a kid and your parents were like, hey, since Tommy jumped off a bridge, are you going to jump off a bridge too? In my case, the answer was probably yes, as long as it wasn't too high. And then fear. And I boil down all of our human fears into two things: the fear of rejection and the fear of failure. There is no third thing. And there actually is no failure. You know, as long as you have your person, your ability, your skills, you can always get back up and start over and do it again. And then life distractions. The busier life gets, the faster things go. It's kind of like in one ear, out the other. We are a deletion creatures. We hear something, we're like, it's like the telephone game as a kid. Oh, I heard this. And we got these things always getting our attention. I'm going to pop mine over there. And this is the reality of why more people aren't successful, because they haven't defined success for themselves and really stopped to understand the game. And that's what we're going to do together. I'm going to show you the game today. And then what we're taught. How many of you have really been taught about how money works? And in a second, we're going to start simply with some definitions, and I'm going to show you how money actually works. Look at this guy. Got his hand out like usual, per usual, Uncle Sammy there. And let me ask you all, and this is an interactive part, so pop it in the chat. What's the definition of money? Let's get one we can all agree on. What is your definition of money? I don't want you to be beholden to your money, because money is not going to give you freedom, but it's going to be a tool. It's going to be a tool. It's a tool. So think about this. We're going to give our money for our home, home for money, money for car, car for money, money for food, food for money. Nothing more. It just got too dang hard carrying around sheep and wheat and barley. And, you know, it had to be an exchange of value. That's all money is. And then what company uses compound interest? Now, you might say, hey, Jason, banks. And I'd say, almost. Banks do not use compound interest. Just think of this. If you go in and you take out a $100 bill, but you take your money and you write your name on that. You write Terry, I just looked over, you write Terry on this $100 bill. Terry right across the front, you hand it to that teller. Does that teller go back and put it in the magic Terry box where it stays safe forever? Well, that'd be cool, right? So next time Terry went back, they could get that $100 bill with Terry, T-E-R-R, written right across the bill. No, that's not how it happens. Money, once it goes into the bank, it becomes a liability. It has to be in motion. So the banks instantly take that money, as I'm going to show you later, and they put that money to work. It's the same as where we eat our fish from, right? We're not going to eat our fish from a stale pond. We want it to come from a river, from a stream that's flowing. It's like our body. If we don't move it, if we don't get up and do the workout and take care of ourselves, guess what happens? We get old, we get stiff, we don't want to move. So no company uses compound interest, but the law of motion, the natural laws always apply. And here's a good one. Are your dollars worth more today or in the future? And want to take a guess at this one? And if you said today, you'd be right. Let's think about this. If you had a dollar 20 years ago and you went to the store to buy your favorite candy bar, back then it was probably Snickers. So I'm going and buying with a dollar, how many Snickers? At least 2, right? Maybe 2, maybe 3, maybe 4. Today, think about taking that same dollar bill to your grocery store. How many Snickers could you get? Not even 1. And to buy the giant size ones, you'd have to have probably 3 to 4 times the amount of money. We got a Hershey's almond, Reese's peanut butters, 3. Oh, we got a whole bunch of different ones. Heath bar. And taxes. Are they going up or down in the future? What do you all think? Up or down? I'm going to say, if you go look at the usdebtclock.org, that if they don't go up, what's going to happen? They're just going to tax us on more things. Because the truth is that we're at a historically low period in the history of taxes. At one point, people were being taxed up to 94%. So taxes most likely are going up, but if not, they're just going to tax us on more. And then here's a fun story. What do you know about your retirement account? Now, Robert, I'm going to pick you. I can't see you. It's a lot more fun when I can see you face to face. But Robert, if you're okay, you and I are going to be partners. And Robert, you kind of know me a little bit. We haven't really met, but you see me on the different webinars, educational things. And so in this partnership, Robert, here's how it's going to work. We're going to be partners, 50-50. All right, off to a good start so far, right? And you're going to put all the capital into our business. I, your partner, am not going to contribute a cent. Okay, you're going to contribute everything. And so you might be thinking, Robert, and everyone listening to Robert's scenario, I don't know if I want to do this. Like, Jason's not going to contribute anything as my partner. And then I'm going to tell you the next rule. Say, okay, now, Robert, you can use this money, but you're going to have certain restrictions, limitations, and penalties to use the money. And then once you get to a certain point, you're required to use the money in this kind of structure. You don't really have control of it, but you know what? I'm such a good partner. I'm going to have my hands off. I'm not going to do anything. You are the one that is contributing, taking that little seed and growing it into a great big harvest. It's going to be okay. Promise you, I've done this millions of times, Robert. It's going to be cool, right? What do you think Robert's thinking so far, everybody? You think he wants to be in this partnership? And then finally, I'm going to tell Robert, well, Robert, you've done it, man. High five. Psh. You've taken this little tiny seed and you've grown it into a great big harvest. And I'm going to come sauntering in. Maybe there's a little smell of alcohol in my breath. And I'm going to walk up to you. I'm going to be like, hey, man, crushed it, Bob. Give you a little elbow. Hey, man, I'm going to need my 35.5%. Cool? And that's how the partnership is. When we're putting money in a qualified plan, that's what we're doing. We're locking it up without control, with a partner, with a contract that wouldn't hold up in a civil lawsuit. But we're still doing that without fully understanding. So if you know how to use your retirement account and it is growing and it is doing all things, that's awesome. But if you don't, I just want you to think about that. And that might have been a lot between defining money, taxes, inflation, and everything else I just talked about. That might feel like a lot. But I promise you, just hold space that if that felt like a lot, let's just replace it with simple, logical math and mindset that empowers you. You guys like that? So what is this magical method, right? What is this method we're going to use to map out the millionaire mystery? Well, it's only 3 parts. Remember how I said simple is simple? We're going to keep it only 3 parts. The first part is the machine. And with the machine, you're going to have a certain amount of time you're using the machine. You're going to have a marathon. And if you saw earlier on one of the slides, you might have saw me in an Ironman, finisher's gear. And I don't run a marathon until I've at least swam 2.4 miles and ridden at least 112 miles. So call me just, a normal everyday person that does crazy stuff, but I don't like running. But if I'm going to run, I'm going to do it after doing a bunch of other hard stuff first and then run, because I'm not a great runner. And by the time everyone else is beat up, it makes me look better in my running. I just figured that out not that long ago. And So it's thinking long term. That's the point. That's the second thing here. And then finally, the millionaire mystery. Because money, money. Who doesn't want some more money in your life, right? When I ask that question, all the hands don't go up. I know I got some people not paying attention. So let's jump into this. The machine. What is this magical machine, Jason? What's this thing that you're talking about, especially for all you new folks? I gave it away early, but here it is with a little bit more definition. It is nothing more than a dividend-paying, cash-rich life insurance, whole life insurance policy from a mutually owned dividend-paying company that has been paying out dividends for every year they've been in business, well over 100 years. And we have 5 of those partners, and they support the process of infinite banking. But just as importantly in life, we must know what this is not. We are not talking about index universal life. We are not talking about variable universal life, IULs, VULs, ULs, or term. Because why? There is no control and there is no guarantees in any of those products. And for banking, I feel like each of you, myself, my family, my wife, we take on enough risk as it is. I want you to transfer the risk to somebody else. Does that sound like a good plan to you? If you nodded your head, then let's keep diving into this. Now, this is an interactive part. I threw this right in the middle, and this is a fun part. So we're going to draw a little T-chart. The top left, we're going to put bank, and the top right, we're going to write policy. And underneath both, we're going to write the word liquid. My definition of liquid is probably the same as yours, right? Money that's accessible, money I can get right away, money that I can just use whenever I want to. I would say yes, and it's not locked up in financial prison. That's my little cheeky version. Now, if you have a high yield savings account, which I know a few of you do, I want you to write the high yield amount that you're getting paid right now from your money being stored in the bank. On the right side, we're going to write 3.25%. That's G1. What's G1? G1 means guarantee. Guarantee number 1. That's the worst this can ever do contractually. And now on the bank side, next line, taxable. All of the growth on the 4.23, 4.24, 4.25% that was posted in the chat is going to be taxable growth. You're going to tax at the end of the year on that money. Under policy, write tax-free. If you want, you can write tax-free loans, tax-free growth, tax-free distribution. It's all tax-free. You're putting in money after taxes when they're historically low, and you're growing them forever, uninterrupted and compounding and tax-free. Under bank, unstable. What's your definition of unstable? I'm going to give you mine. Think about this. Think back to the beginning of 2023. This is how I define being unstable in terms of being a bank. You had the Silicon Valley Bank, over $200 billion fail. And then within a month, you had Signature Bank fail, $100+ billion more. How in the world did that happen? How was that allowed? That banks with over $300 billion just failed, went bankrupt in a blink of an eye within a month. How does that even happen? Well, this is how it happens. Our whole banking system is set up to operate with the fractional reserve lending is how they do things. And what that means, just to make it easy, when you deposit 10 grand in your bank account, guess what? The bank only keeps 10%, $1,000. The other 90% is lent out. And through a series of loans, that 10 grand becomes $100,000 quickly. And I'm going to show you what this looks like shortly. But they fail because now when people get nervous about the money in the bank, or maybe what the bank's invested in, guess what? When they go to get their money out or they do a run on the bank doesn't have any money. And then you have, on the policy side, stability. Remember earlier when I said that every single one of these mutually owned dividend-paying companies had been profitable every year they've been in business, well over 100 years. Our partners have been profitable 119, 137, 148, and 160 years. That's crazy. The one in this example, the 3.25%, is where we have all four of our simple family banking policies, and they have been profitable for the last 148 consecutive years since 1877. Is that impressive? And then if you ask the same question that you would ask on the bank side, you would say, why? Why is that true? Well, they practice a different kind of economics. You can only borrow money when the money is backed by something. It's like going back to the gold standard in 1971, right? The dollar has to be backed by something. So when you take a loan, you borrow against the cash value you have, and you borrow against the money there. That's called Austrian economics. That means it's sound money. And the life insurance company is only betting on one thing. What is that? When do you and I graduate? I know, I'm breaking the news early, but you guys are going to pass away someday. And so what does the whole life company really care about? How long are you paying your premium deposits? How long am I paying my premium deposits so they can deliver on their guarantees? Now let's go back to the bank side. Unprotected. So as an entrepreneur, you know that it's simple, right? Everything's easy. Like you just sleep in every day. You go to bed whenever you want. You take siestas during the day. It's simple. Well, what would happen now? Remember the wealth killers? If something happened on one of your rental properties or in your business and someone sues you and you have money in a conventional bank, guess what? That is public knowledge. And a good attorney can get at that through liens and judgment. But then on the policy side, it's protected against liens and judgment. If you're an entrepreneur, if you live in the great country of Florida, like myself, or the great country of Texas, it's fully protected. It's fully protected in most states, over 37 of them. And the ones it's not, it's still more protected than it is in a bank. And so far, if you look at the two sides, left side versus right side, you have, on the right side, you have guaranteed, tax-free, compounding, uninterrupted growth in a stable, protected from attorneys, away from Uncle Sam environment where you have access to it. But wait, you're going to hear me say this a few times a day. On this Tuesday, it gets better. How's it get better? Well, under the bank side, you have no death benefit. You have 50 grand, 100 grand, 200 grand in the bank. You take it out, you go back to zero. Guess what? You're back at zero. You've interrupted the compounding. You have no more liquidity because you used it. There is no money to protect, and there's no death benefit. On the policy side, even when you use the money, guess what? You still have a tax-free death benefit that's going to be a multiple of whatever you have put into the policy based on your age, your rating, the amount you're putting in. Okay, but it's a multiple. Like I think my first policy was almost an 18x multiple on what I put in at that time. And that is a guaranteed tax-free estate that'll stay out of probate. That'll go to your loved ones or to the cause you love, right? And so if we're looking at these two sides, I have now promoted or demoted, depending on how you look at it, every single one of you here participating today. Now you are all consultants at your bank, especially the ones that have the high yield. And this is something, again, don't believe anything Jason Patrick Sipple is telling you. I want you, each and every one of you, all of you, to think for yourselves. But the banks have 4x'd the amount of specially engineered whole life that they've bought since 2012. They now own over $225 billion of this stuff. That's crazy. That is nuts, is it not? And now, since you all trust me as an honest banker, now, Jamie, you are going to be buying a new car. So if you feel like it, pop what color car your new car is going to be. And you've been storing your money because, Jamie, you have strong discipline. You are a disciplined warrior, and you've been storing your money in Jason's bank. Okay. And now I've been paying you 4%. So a little less than the 4.23, 4.24, 4.24. But I've guaranteed that for the last 5 years, no matter what's happened in the market, I've given you 4%. And you've been saving up. Well, if any of you want to hear buy a Lambo or, a Lamborghini, a Ferrari, just add in zero to this. It works whether it's a Fiat or a Ferrari. And now at 25,000 at 4% that Jamie has been saving comes in and says, hey, Jason, I'm going to buy my new vehicle. I'm going to get a high five. Good job, Jamie. I've seen how hard you've been working to save your money. Incredible. That's incredible. I can't wait till you get your new vehicle. That is going to be so cool. But Jamie, don't take the money out of Jason's bank. Instead, I'd like to give you a loan. And I'm going to give you a loan, right? You can finance it through Jason's bank too at 6% for 60 months. Remember, I'm paying you 4 and I'm going to charge you 6. But at the end of that 5 years, you will make money. How many of you think Jason, me, is being honest with Jamie? Do you guys believe me? Do you believe that Jamie will make money at the end of that 5 years by earning at 4 and borrowing at 6? Jamie's paying back the loan at $483 a month. Future value calculator says $28,999. Now, many of you, like me, might have said, hey, 4 minus 6 is -2. But you have to know what the money is doing. Because look, the future value is $30,525. I was indeed telling the truth. You've all made, Jamie's just made $1,526 and has a new vehicle. So let's show you now what the banks are doing with your money. And by the way, if you already know, like, hey, I have to have a conversation with Jason, I have to make sure that I know how to take back control of my money, how to put my money to work, how to stop playing their game and start playing my own where I control it and I have guarantees. Scan that QR code. But let me show you. So you guys already trust me. I already showed you how honest I was with Jamie. Now I'm going to show you how you're going to start depositing all the money you make into Jason's bank. So you're depositing 100 grand and I'm paying you 4%. Way better than the 0.07% or 0.03% or 0.01% that you're currently getting if you don't have a high yield. And remember what I told you earlier, when you deposit money in my bank, is it an asset or a liability? That's right. It's a liability. So what happens? I have to move that money out, right? It has to go out. And it goes out to someone that's buying a new home. Whoever wants a new home, congratulations. Today's your day. You got your new home. And now what happens? That money has to do what? It went away from the bank. And remember what I said? It's going to flow back to the bank. We need a place to store it. So the seller puts the money back in the bank. And the bank, remember that series of transactions, lends the money out again. Person that just bought this new home, it's like, hey, we got to keep up with the Joneses. We can't keep driving this beater. Let's get a blue BMW. And so now the bank, Jason's bank, gives them a loan for 8%, right? The home loan, 7%, the car loan, 8%. And what happens with that money? It leaves the bank, but where does it go? It boomerangs and comes right back. And then what happens? Now they got the new home and they're like, you know what? This backyard would be beautiful with a patio and a grill and a water feature. So now they take a home remodel loan out. Now they're going to pay 9% back to the bank. Remember, the whole time the bank's paying them 4% on the money. And then, there's things when you get a new home. I've had 2 new homes in my life at this point, and we'll have more. But every time you get a new home, you forget about a lot of the things, the blinds, the garbage cans, the extra furniture if you got a bigger home. And so now what happens? You end up with a bunch of debt, and then you get all those mailers, and you end up consolidating the debt. Instead of paying 25%, which is the average credit card right now, you now have 12% to consolidate that debt. And then that money goes where? It comes back to the bank. So every single time the money that's deposited in the bank has been lent out for somebody to get what they want. And the bank's taking on very little risk in any of these transactions. And then what happens? The money flows back to the bank and it flows out again and it flows back again. Out again, back again. It's that circle that keeps getting completed over and over. But let's look at what really happened during this year. We're going to call this a 1 year. The banks 7 minus 4 make 3% off the home. 8 minus 4 make a 4% off the car. Simple math, right? 9 minus 4 is 5 off of the remodel, off of that new backyard I talked about. And then for the debt consolidation, for the things we didn't think about, 12 minus 4 is 8. And if we add those up, we get 20. Now here's the magic question. How much larger is 20% than 4%? Is it 16% bigger? No, right? It's 5 times bigger. So in this transactions, Jason's bank made 500% on your money. And when you look this up, again, remember I said, do your own thinking. And BauerFinancial.com, banks make between 400 and 1,300% off of every single dollar that you leave in the bank. How many of you would want to make that kind of return on your money? And the great thing is if you said yes, and you're willing to think long-term and you're willing to change one thing, you can do the same thing that the banks are doing. This is why we teach you to become your own banker. Now, this one, remember how I asked you earlier? How many of you want a 35% raise? It means if you're making 100 grand, you're now going to make 135,000. You guys want 100,000 or a 35% raise? Let's look at this annual pattern of American spending. I'm going to tell you right now, after 3,000 plus phone calls, this first number, 20%, is way off. I just talked to someone the other day that their 2 vehicles is $400 a month more than their mortgage. That's crazy. So now we got 20 cents of every dollar going to the cars, trucks, Lamborghinis we talked about. You got 30 cents of every dollar going towards housing, 40% for the fun, for the magic, for everything else that you need, electricity, food, fun, whatever else. And then we're going to be super generous and say that Americans are saving 10 cents of every dollar. We haven't saved, by the way, 10 cents of every dollar since 1985, except during the pandemic when we were given a bunch of checks of fake printed money. We've been saving an average of less than 5%, believe it or not. So let's look, like Shane said, he's in for the raise. You always are, Shane. When there's a way to make more money, you are there to learn about it, my friend. So now, with the vehicle, 5 cents of every dollar is paid to interest to the financing company, to the bank. So then we're going to take that 5 cents and we're going to give it back to our family, okay? Then in the next, with the home, if you've bought a home in the last 5 to 7 years, whatever you do, do not do this. Do not go home and look at how much of your monthly payment is going towards principal and how much is going to interest. Because you have about 70 to 80% of that money going to the bank. And guess how often we move in America? Every 5 to 7 years. So if you're the bank, you're in a pretty good position to make 25 cents of every dollar. But now imagine that you take back control of this, as I'm going to show you later how to do that, and you transfer that back over to the right side, to your savings, right? Following the first law of wealth of paying yourself first. And next, you have everything else. And we're going to say there's another 5 cents there. We've added 35 cents to the 10 cents you're already saving. Now you have 45 cents of every dollar you're saving versus giving it to somebody else. And you're going to need a place to store that. And this is what the 1% have been doing since 1910, by the way. Fun fact, the 1% has been saving 38% annually since 1910 on average. And so now, as you've seen, if you can change your environment where interest is being paid, like if you're paying interest to others with car payments, with mortgage payments, with credit cards, with personal lines of credit, whatever you're using and you're giving someone else interest, that is an opportunity to change that pattern with a little long-term thinking and using this system, right? Using this engine. How have you all paid for your vehicles? Have you paid cash with them? Have you paid, leased them, rented them? Have you paid interest to someone else? Like I just showed, 5 cents of every dollar. Or maybe you've, 5-finger lifted them, borrowed them, you'll say. But what if there was a better way to finance all your vehicles? One where you keep control, one where you keep the control, where you have guaranteed growth while you're using the money. Let's look under the hood and look at the machine. And remember, with the machine, we're going to have a couple rules. So we're going to define this. When we're talking about your system and you're making deposits into your systems, we always look at whole life as a cost. And so we call it deposits. But now we're calling it premium deposits versus just premiums, because you're putting money into your system. You're thinking about your finances a different way. And the age doesn't matter. It doesn't matter if you're 21, 31, 41, 51, 61, or 71 years old. As long as you have good health, as long as you are insurable, then this system is going to work exactly like I'm showing you for this example. And finally, I think this last piece, right, that I'm not going to talk about, but I will mention because I believe it is probably the most valuable piece, and it's not even the piece of banking. It's the cherry on top, the death benefit, the guaranteed legacy. Super important to any parents that are out there. We always want to leave our kids in a place that they're positioned to be able to be set up for success with not only the money, but the thinking, right? And so let's look under this hood. Jamie, you bought a cash. Jamie, this is a perfect example for you then, because I love this, all right? So Jamie, you got the new vehicle before at Jason's bank. Now you're going to use the machine that I'm showing you and teaching you and mentoring you how to do it. So Jamie, you're depositing, instead of in my bank, you're depositing $10,000 a year in your bank. This is Jamie's bank. In year 3, you're going to take a $25,000 loan out, okay? But as before, you're going to be an honest banker. Instead of paying $483 a month back to Jamie's bank, you're going to now pay $500 a month. Times 12 is $6,000. Are we tracking on the math so far? So now in year 3, you took a loan, you pay it back over the next 5 years. And we get to the end of this 5 years, let's kind of tally everything up and look at it. Your total deposits into Jamie's bank has been $70,000. Your repayments on the loan you took back to yourself is $30,000. So you've paid $5,000 of interest back to yourself that you would have paid to that third party bank earlier. And you've gotten the $25,000 tax-free loan. And you have a total of $75,000 left in your system. And look, your cash value is still $67,000 and change. That's 91 cents of every dollar you have, and you have the vehicle. Let's pause there for a second. Before I show you something crazy and something that I would never teach anyone to do, in year 8, when Jamie needs another car, let's just pause here and take a look at that. Have any of you ever had the vehicle you purchased 5 years ago and 91 cents of every dollar you purchased that vehicle for and protection? Anybody? If you use this one thing that people do 13 times during their life, I guarantee every single person listening to me right now would be in a better place financially. It just takes a little bit of patience. So now, Jamie, after 5 years, your car has been, spilled on, stomped on, sneezed on, and everything else. And it's not the pretty, fresh smelling, new car smelling car that you bought 5 years ago. You need another vehicle. It is time. So now, this time, we're going to do something crazy. Like I said, just super nuts. I would never tell anyone to do this. You're not going to make any deposits in your system anymore. You're going to stop after year 7. You're still going to take a $25,000 loan from that $67,000 and change, and you're going to continue being an honest banker. You're not going to steal from Jamie's bank. You're going to pay it back at $500 a month over 5 years. At the end of 5 years, you made 0 deposits, the tally. You have $30,000 of loan repayments, and you've taken a $25,000 loan. So the net, like in and out for those years for you, has been a $5,000 difference, right? You're ahead $5,000 of what you paid yourself. But look, the growth, your policy has grown by another $23,000 of cash value that you can use. So in car number 2, Jamie just made money, folks. How many of you want to make money for the cars that you're buying, owning, and driving? Anybody? I do. That's why our Ford and our Hyundai, we are now making money on those because we've paid ourselves back the $33,000 the banks would have made on our money when we took over those notes. Because you don't have to go buy a new car. You can take over your existing note. I just thought of that now. You're welcome. And let's keep going here. So far, I'm going to show you the rules. There's 3 rules here. This first one I like to go a little hard on, and today maybe I'll dial it back just a little for you, just to keep it fresh. But this first one, the pay yourself first. This is kind of like Warren Buffett's first rule. Don't lose money. Second rule, same thing, don't lose money. Third rule, see the second rule, see the first rule. Same thing here. If you can't pay yourself first, if you can't stop being last in line for your money, think about every time you get on a plane and the stewardess says, okay, everybody, let's go over the safety things. Everybody's like, okay, just get through it. We've seen this before. But when that oxygen mask pops down, they always remind you, yes, you might want to put it on yourself first. And that's what you should do, because you might be inclined to want to put it on your kid, your grandmother, your parent, your wife, your spouse, someone that you love first, but you need to put it on yourself first. Why? Because if you're not good, how can you possibly be good for anyone else? So you're putting the oxygen mask on, and now you can take care of other things. The second law is pay yourself with interest. That's how Jamie made $5,000 back to the system both times that the cars were bought. And then third, you can recycle and recapture your money. You're doing this by continuing to make your premium deposits into your account. And if you take a loan, you're paying yourself back. That way, all of that money keeps circulating in and out of your banking system. Does that make sense? So if this works for a car or a truck, what else can this work for? Our son Connor is going to use this system, what I just showed you, to buy his first computer, probably in the next month or so. So remember at the beginning, I promised that we would map out the millionaire mystery. I promised I would show you how to turn your debts into assets. Now we're there. Let's jump in and let me show you how we can turn your debts into assets. So after seeing this presentation, or a version of this presentation, one of the chiropractors in Minnesota came up to my partner, Chris, and said, Chris, that was a great presentation. Can this work for me? Can I take charge of my debt? Can I turn my debt into assets? And you know what the answer was? It's the same answer I'll tell each and every one of you when you connect with me and schedule that call. He said, it depends. The guy was kind of like, well, what do you mean depends? And the next question was, how much are you paying yourself? So, well, not really saving. He said, okay, well, are you putting money into a retirement account, a qualified plan? And the chiro was like, yeah, I am actually. I'm putting money into my 401k every year. I'm putting $25,000 a year into it. And then Chris said, will you change one thing? And the doc's like, sure. If it will get me out of debt faster, will I stop paying $69,200 or $324 a year for 19 years to the other families, to these other banks, to the Bank of Discover and Lowe's and Nordstrom and Wells Fargo and et cetera, West Marine, BMW, right? Bavarian Motorworks. Am I paying all this money to them for that next 19 years? If I could stop doing that, I will listen to you. And so Chris said, okay, we're going to start your specially engineered policy. And remember, the first rule was that it's a marathon. It's going to take time. And so the doc said, okay, well, how much time? So let's go through this and show you how long this took. In year one, this doc puts in $25,000. Remember, he's not changing anything. He's not working harder, working longer, taking on any risk. All he did is start one of these specially engineered whole life policies, deposits $25,000, has $14,863 he can use. And so what's he do with that? Does he go spend it? No. He pays off Discover, Lowe's, and Nordstrom, or pays Nordstrom down. Recaptures $448 a month. Where does that money go? It flows back to the doc, okay, to the chiro. So he's taken a loan out. He's paid off the loans. He's going to pay the simple interest on the loans only. That's a detail we don't really talk about here. And then year two, he's going to make the same deposit. Look, his cash value goes up. Why? Because of the uninterrupted compounding interest. It gets bigger and bigger and bigger every year. And I'll show you that. He's made that $5,374 of payments back to himself instead of Discover and Lowe's and Nordstrom. And what's he do with this $21,000? He pays off the next 3 debts. So do you see what's happening so far? We're only 2 years into it, and 5 of the 9 debts are paid off, and the next debt is already reduced. 2 years. He's only changed one thing. Because all that money going into that future account was doing what? Being locked up for his future. It was under penalty if he wanted to use it. But now the doc said, you know what? Let me build it up in a place where it's guaranteed, where I have control, and where it's growing forever. In year 3, something really cool happens. And typically this is going to be year 3, year 4, year 5, or even year 6, depending on age and what we're doing. But there's a point where every dollar that you put into the machine gives you more than $1. In year 3, this doc puts in $25,000. He's got 541 additional tax-free dollars he can take as a loan. He takes that, he pays off BMW, pays off the West Marine, knocks the condo down, recaptures a total of $3,677 a month. It took us 2.5 years to recapture $3,300. This doc's right there. He's a little bit more now. So he recaptures that money. And remember, I've mentioned it a few times. It's a marathon. Year 1, 2, and 3, we put in $75,000. We've taken loans for the max amount available in each year for a total of $55,000. How much is left in the policy? Is it $20K? You might say that, but that'd be wrong. It's actually $75,000 left in the policy. Remember, we're not borrowing the money that we put into the policy. We're just collateralizing it. We're borrowing against it from the general fund of the insurance company. Let's go back to year 4. And remember, we're trying to make something that's super boring, super exciting to show you how to take back control of your system, of your money. So year 4, he's going to do the same thing, makes a little bit more money, doesn't pay anything off, but we're down to only $160,000 in debt. Year 5, same money deposited, save payments back to himself. We're almost at $5,000 a month recaptured and recycled back to his family. Now, year 6, something really interesting happens. Is one of the things we have to be careful with is that there's only going to be a certain amount of money that we can stuff into these policies before we have to expand the system. Think about it, all entrepreneurs. If you start running a successful business and it's doing so well that it becomes a cash machine, what are you going to do? Would you expand it? Yeah, that makes sense, right? So now you're going to expand your banking system. You're going to add another warehouse of wealth. And that's what the doc did. So we opened a second policy on his body. Could have been on a spouse, but this particular case, it was on him. So now he's putting in 10 grand, cash value of 13,000. So he's got 3,000 and change of extra money. He puts in that 25,000 in the second policy, same amount available as before. So now he's got payments back to himself, 82,000. He's 6 years into the process. It was going to take 19 years. So I'm just asking you, I'm in Florida, but is 6 years less than 19? We can agree on that's true. Would you rather be out of debt in 6 years or 19 years? And if you like seeing a map to that, guess what? Not only do we have this debt blaster tool, we have a gain projector tool, but we can actually take your scenario, your actual debts, and the amount of money that you're paying yourself when we design these specially engineered policies, and we can engineer this and show you what is going to be the fastest mathematical way to pay this off. We can show you how much interest you're going to save, how long it's going to take, and exactly how to do it, what debt to pay when. And if you follow the map, you'll already have that map that doc had. And the doc just did it by practicing. But now you're going to not only just practice this and be the banker, you're going to have a map to show you. And you're also will tell you how long it'll pay all that back to build up that opportunity fund so you can put that money out to work. How amazing is that? You saw where it was going to take 19 years of regular time, the no plan, and now the doc did it by changing one thing in 6 years. So my belief is that progress equals happiness. If you're new here, you must feel like a sense of relief because now you know there is a better way, factually, a way that you can move forward, you can make changes, you can take back control, and you can apply this. And I used to ask this question at the end of almost every single thing I led in corporate America where I was leading a recruitment agency. How do you eat an elephant? I'd ask a dad joke and a stoic quote and something like this. How do you eat an elephant? It's one bite at a time. And as my wife Patty says, you don't start at the ears. Don't start gnawing on the ear. Start at the bottom, work your way up. It's just like the man and the woman at the top of the mountain. They didn't just fall there, right? They weren't dropped in. They walked there step by step by step by step. And they had obstacles. And they had to go around things, under things, over things. But they got there through persistent, consistent action and changing one thing. And so when you make the progress, celebrate, high five, pat yourself on the back, give yourself a hug. Wire that feeling in because that new feeling in your nervous system is what success feels like. But remember earlier when I promised that we would map out the millionaire mystery? Let's see what happens when the doc keeps being an honest banker. And he keeps paying the condo back and paying the home back for the amount of time that was still owed. Because remember, he took over the notes from the bank. So if he does that, he recaptures $500,000. But it gets better. It gets more exciting. Don't forget, that was earning guaranteed compound interest and probably a dividend. So I'm being very conservative, telling you it earned 4%. He probably earned 5 to 6% on all that money. So it's going to be a lot more than $750,000. And remember, we didn't even show you how much you would have got back for the boat, for the Beamer, for the other things, because you keep paying yourself back. He's well over $1 million of his money that he kept. How many of you would like to keep more of your money? How many of you? I'm guessing everyone here, right? So now that you know this, if you don't do this, aren't you stealing from your kids, from your grandkids, from your grandkids' kids? If you're not applying this, you're not using this, you're not teaching this, aren't you stealing from your future generations? It's like Warren said, if poor people would just do what rich people do, they would not be poor anymore. I don't think Warren said that, but what a great quote. What a great quote. And so now you've learned, right? You've learned that the banks are making 400 to 1,300% annually on your money. That's nuts. And how many of you, I already asked, want to make that kind of return on your money? We showed you how you can turn your debts into assets. Factually, a better way to finance everything while keeping control of your money and actually keeping more of your money and protecting the family simultaneously. That's the power of becoming your own banker. And do you know what the most common thing that's been said to me over my 3,000 calls is? Jason, I wish I would have known about this 20 years ago. And here's the crazy thing about that. Do you know who knows about this? Rich people. And I guess they just didn't let you into their circle. Well, ladies and gentlemen, welcome aboard. You are now cruising in style. You know how the wealthy have built their foundations, and now you can do the same. And now only one of two things is going to happen here. And my question is, are you better off with or without this process? Now that you know what the wealthy have been doing for hundreds of years to build, keep, and multiply generational wealth and legacy, you're at that moment that so many people have been at. And many people, like you, have chosen to take their strategy call and work with me. Some of you are even here on this call. You've worked with me for multiple things. We're still working together. Not one person has ever been disappointed that they took action, because no matter what, you're going to walk away knowing more and having the resources to take back ownership. And if you're willing to do that, then why are you waiting for things to change? Or you're going to maybe practice the definition of insanity, where you're going to keep doing the same things. We're going to fast forward a year from now. And if nothing's changed, do you expect your outcome will be any better? Most likely, you'll have more debt, you'll be more stressed, you'll be more unhappy, and you'll feel that weight, that burden continuously. Worried, stressed, frustrated. And I know I can help you. I've helped thousands of people like you take back control, build their guarantees, and build a legacy. And I know I can help you too. So either click on what I put in the chat and schedule your call, or scan that QR code. Get a call with me today. Schedule it. Don't wait, because when's the best time to take action? 20 years ago. When's the next best time? Today. And if you don't, it's okay. I still love you. I'm super grateful that you came to another Take Back Control Tuesday. Either way, be blessed. You're doing what very few people are doing. You're investing in yourself, your energy, your time, and I'm super grateful, and I'm not confused. Have an awesome rest of your week. Take care.